Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey, audience and listeners, this is James Kandasamy from Achieve Wealth Through Value at Real Estate Investing podcast. Today, I have Sakar Kawle from Baltimore area, and I'm happy to have him here because he's one of the guys who have done very well building up his portfolio in around 200 single-family houses on his own, right? So 200 houses, that's crazy, right? And after that, he's doing a multifamily gig as well. So, hey, Sakar, welcome to the show.
Thank you, James. I appreciate it. I respect your content and the all the work that you and your wife do. So I definitely respect everything that you guys do. I know it's a hard work, so I appreciate you having me.
Yeah, I'm sure. I mean, right? You have 200 single family houses. I mean, when I started in real estate, you're a technologist like me as well, right?
Sure.
And when I started real estate, it was very amazing on how simple calculation in single family houses can make 8 to
Sure.
9% cash on cash, right? So
Absolutely.
and that's a big deal. I mean, if you can see something very proven, that's very important for you to go dig deeper because that makes you money, right? Compared to CDs and
Absolutely.
all that, right? So
Absolutely.
tell me. I mean, you immigrated to this country in 1997, right? To
Sure.
start your masters,
Yeah.
and I think you got some layoff, and after that, you want to look for some stability, and you've been investing since 2000, right? So tell us, how did you transition from being a technologist to how did you find a passion in real estate?
I know. Well, thank you. It is, pretty much one house at a time type of story, James, that, I came in 97 and did my MS through Clemson University, got on the job, and I think it was like first or second year.
Mm-hmm.
You're working hard, you're as a consultant, traveling, whatnot. And, typically as folks in IT would know, that you roll off on Friday and suddenly you don't have a project. But around that 2000 timeframe, when the downturn came along, everything was, all the companies were cost cutting, and we didn't know because we were all on projects all the time. But for me, as young as I was back then, we roll off on Friday, and Monday morning we go into our office, and by 10 o'clock, all 12 of our consultants that rolled off the project were laid off. And at the time, I was engaged to be married in, I think, December, and that was like April at that time when I was laid off. And it was an unbelievably rude awakening that I don't have any control on my future at all, And at the time, now just let's tying back to the real estate story, is that in my family, we have a lot of real estate back in India, where I'm from. My sister-in-law is one of the major developers in my town. My mother has invested a lot in lots. I personally own a lot of real estate in India as well. So the story connected here as well as to, hey, how can a person with moderate means can start investing into single family, or any type of real estate for that matter, right? And back then it was 2000. I was studying for my architecture and all that, which is like systems architecture. So I saw a ad for Carlton Sheets. Not many people recognize that name now. But Carton Sheets is one of the gurus from, sort of the 80s era. And if you see his content, it's analogous to what happens still now as far as cash flowing real estate, things like that. And folks who studied real estate during that era will also equate to a name called Ron LeGrand. Ron LeGrand is another huge name who has done thousands and thousands of transactions into all sorts of properties, and whether it's single family, multifamily, lots, development, commercial, lease options, things like that, you name it, right? So I started back then. I mean, it wasn't an era of podcast or bigger pockets, YouTube. None of this was there, And where that equated me was that then I got transferred over to Maryland area where I found my full-time job, and I quickly discovered that Baltimore was a town where the cash flowing numbers still work. And then I started, I think my first purchase was like around 2001 timeframe. And that's when the story began. And when I realized the power of cash flow, and pretty much, as I said, like one house at a time, I would buy during and of course, we all know what happened in the 2008, 2009 crash, right? And at that time, I quickly learned that, yes, the prices have gone down. And in that post 2008 era, we bought a lot. I mean, I'm talking buying houses like 12 to 14 houses a month. And those were the real times that we were buying so much that I was losing track of when my closing dates were coming up. I literally had a notepad where I would write the addresses, the price, and all of that. And I mean, it was so crazy at the time that the houses and the prices were so good that we would buy the house and basically sit on it because we would have prior deeds that we were really rehabbing and things like that. So basically, I did the double duty that I would, still work at my IT job and slowly, one by one, still buy houses. My wife has been a very much an able partner, so all along. So, right now we own just about 200 houses and bunch of mid-size apartments and whatnot. So all of that, combined with an active partnership and able help from my wife as well. So just like yours, so we went through and we did the heavy value adds, repositionings. We do a ton of voucher-based housing, whether it's Section 8 or many other type of voucher programs. So that's in general how it is. It's a very what do you call on the ground, boots on the ground, doing good work, providing value to people. Where we do right now is we only do like premium rehabs, whether it's granite countertops, all refinished kitchens, bathrooms, basements, things like that. So it's not a typical rehab wherein, you're just painting or changing light fixtures, things like that. We are really going in, changing in plumbing, electric. So on an average on some of these houses, we will be spending after acquisition, we would be spending somewhere close to 30 to 40,000 on an average just to get that house to that level, basically. And we've been very successful at it, actually. And where we stand right now is that obviously many years have gone by. In the initial years, I would do the minimal, and then come to find out after 2-3 years, when your tenant moves out, you're going back and redoing everything again. So it's for lack of a better word, right? So whatever you would have done 2 years ago, you would have completely sort of lost for yourself. So I learned that hard way. But now what we do is we do the entire house properly as far as mechanicals and things like that. And we can certainly go into details, but now it's at a point where even if your tenant gets moved out, you're doing, like very minimal painting and things like that, and changing over to the new tenants. So that's kind of a high level view, but it's all years of hard work, doing the right thing, whether it's tenants, contractors, lenders, things like that. I say this on a very much on a daily basis all the time, is that just do the right things, and things kind of fall in place, and things will work out.
Yeah, that's crazy. I mean, that's good that you and your wife work like me and my wife, right?
Sure.
That's really good. I mean, it's a partnership, right? And so before I move further, I'm
Sure.
sure a lot of my listeners are thinking about Baltimore. Isn't that the 10x murder rate compared to the other US side?
Right.
So is that true?
It is true. It is true. And where I think you have to separate is that as an investor, you all have to believe in yourself, right? So there's always a town or a submarket, as we call it. There's always areas where you don't want to be, and then there are always areas you think that, geez, there's so much good value and there's so much, common sense that you should go in and invest. So Baltimore in general is made up of so many neighborhoods in general, right? So you have bad parts and you have so many good parts, wherein a lot of good peoples, the mayors, and lots of known politicians also live in those areas as well. So you get all shades of neighborhoods there. And my consistent sort of record has been is that I have always been of the belief that you like people live in a neighborhood first and then in your house. And what that means or what that translates into is that you have to be in a good neighborhood first. There's no such thing as having a great house in a very bad or a crappy neighborhood. Nobody would want to live there, right? So you wouldn't want like bunch of liquor stores or abandoned houses or people hanging out on the corners and things like that. That's not a good sign of any of a good neighborhood, right? So what I want to maybe, perhaps kind of share with a lot of viewers and listeners is that every city will have those struggling, neighborhoods of sorts, right? So you don't want to depend on, what the news on your newspaper or the headline of your, 6 p.m. or 9 p.m. news is. You want to believe that yes, what are the right neighborhoods and the cash flow metrics, do they work or not, and then based on that, kind of do your foot study, understand which are the good neighborhoods, and then go about that, and that's what I have consistently done, is that gone in good neighborhoods, consistently paid more and more than what I used to before, right? So you go in a good, better neighborhood, you're buying, properties that are much more expensive, but I've always believed in the sort of the buy and hold principle, right? So I would go into these expensive neighborhoods, relatively, as you would call it, and still would go in and still do our sort of proprietary rehabs. And boy, I mean, we have been mega successful. I mean, on an average, our tenants don't move out like 4 or 5 years is like really automatic. I mean, our standard lease is like literally 2 years minimum on some of these houses and things like that, which is very much uncommon in the multifamily. Like, yearly lease is what we go by. But on the houses side, you would easily find that 2 years, if your house is great in a good neighborhood, like 2 years is a very modest number to stay by. And people love to renew, stay on. I mean, you have a good property management, things like that. So people really love to stay on those.
Got it. So I know I want to go back to how you get started, right? Because you are a
Sure,
technology, your family had a lot of real estate background in India, and you
sure.
have a lot of things. So at what point or what data did you use in the US while you're working as a technologist? What was the first thing that you saw that said, hey, maybe I can do this here in the US too? What was the data that you see in the houses, or any parameters? What was that?
Sure. So you might find it interesting, James, is that at the time I was not very savvy as that. That's the honest answer.
Mhm.
I use the data saying, okay, I can make the cash flow. The neighborhood looks great. And obviously, I networked heavily on the Real Estate Investor Association here as well. And I found out, what people were doing and things like that. That was sort of the elementary understanding of, okay, the neighborhoods and the cash flow numbers work. This is how it's done here.
Mhm.
And that's how I got started. Like that was my first maybe 3, 4, 5 houses back then, But then I think as a few years rolled by, it was very interesting that I would see Memphis, Detroit, some parts of Tennessee and things like that. These are sort of the darling states or cities, as everyone knows, that these are heavy cash flowing states. Those who are, sort of familiar with those stats, right? And I would take that data and sort of compare with what I was doing in house, and my numbers were surpassing even the nicest charts or the top 2 or 3 of them, right? So this went on since, I think, 2004, 5, I believe. And I think around 2006 or 7 is when Baltimore came on the map. I think I haven't seen the latest stats, but at the time I would clearly remember that Baltimore was one of the top 10 or one of the top 7 cities to invest at that time. And it's one of those stories that you have your own intuition, that you understand that, okay, your math is working better than what the charts are showing you. And sure enough, as we all know, the stats somehow lag what happens on the street. It was one of those stories where you're seeing something and experiencing something, but the stats are not yet showing you. And sure enough, after 2 years, Baltimore was right on the charts, right there among the top. And I was feeling it because I was seeing the results on the street. And of course, and then I doubled down, and of course 2008 and 9 happened, and the prices, the amount of foreclosures, short sales that were there, were absolutely there. And all that, what that meant was I was using all of this data and stuff like that. But to going back to your question, that's not how I got started, but I got wise enough to understand what the data was showing me after. So I was a rookie, but I quickly learned.
Yeah, and the numbers doesn't lie, right? So it's a very
Absolutely.
straightforward thing. So basically, 2003, 2004, and then you went to 2008. Did the crash help magnify your acquisition of houses?
It did.
Okay.
And and it's a hindsight, I should say, right? And what I mean by that is that uh, I experienced what the crash did, right? And I saw the opportunity. But then one of the things I think people always forget is the crash always comes with a problem with the credit, meaning just like as we are going through the COVID pandemic, we are seeing all the bridge lenders are out. Fannie Mae has all these interest reserves and all these requirements, right? 2008 was absolutely similar. Like when 2009, 10, 11 came along, all the banks were out. You're talking like major banks were completely out of lending. If you were calling the bank saying, hey, I'm a real estate investor, I invest in rental properties, people would look at you saying, you are so full that why are you even like, don't you know what's happening on the street? And I clearly remember at the time is that I had a running sheet of banks in Maryland, I think I pulled it from Mortgage Bankers or something like that. And I would go pages and pages. I literally had about 16 or 17 pages worth of sheets. And to answer to your question, it was a lot of hard work. And I didn't know that, okay, I am in a credit crisis. I was almost thinking that, oh, geez, you know what? I don't know why all these banks are not lending. I mean, I knew that, okay, I had a great job. I make great income. My properties are cash flowing. Everything is renovated. But boy, nobody wants to finance. And I did not understand the full context of, okay, because of the market crash, there is a credit crisis right now. I did not have that intelligence back then, but I was doing what I could, and I kind of hustled and obviously found some credit unions and things like that. So I kept the sort of the torch, I kept the baton moving, I should say, and I got through it. But that's an interesting dynamic that I wasn't smart enough back then saying that, hey, you know what, this crash is really helping me. All I knew was, yes, things have crashed. I can see that there are just so many good deals out there. And I mean, just to take that story forward, I would chase the realtors at the time that, hey, can I get the lockbox or can I get a showing time and all that. But I was finding that I was always sort of hesitant or perhaps reluctant. Realtors were hesitant to do me the showings because the guy wants to see 10 properties in one day. I mean, realtors would go crazy that Mr. Sakar, we could not even, kind of get the lock boxes, or many of the properties would fly off the market and things like that. And what that meant actually, James, is that I had to become a realtor myself, So I took the
That's
education.
interesting.
I became the realtor. I mean, I'm still a licensed realtor now. That I became realtor myself. So I was controlling my own destiny. Every time I would go in the MLS or HUD or Fannie Mae, HomePath, any of the properties would come on, I would submit contract sight unseen, because I was so confident on the streets, the houses, and the blocks that I was investing in, because pretty much I would know those things, like the back of my hand, or I would have existing properties on those streets or on existing streets. And once have all that knowledge, oh boy, I mean, watch out. I mean, that's how big deals happen, is that people have precise intelligence and know-how, and they know what their capabilities are, and they know they can gauge that risk. It's all a risk mitigation, or taking the risk in an intelligent manner. That's how this game gets played. And I was buying houses sight unseen back then, and
Mhm.
realtors would call me mad saying, Mr. Sakar, you haven't seen the house. We don't see any showing on our sheets that when you have looked at the house. We don't have any stats as to when you or your entity has gone in and seen the house. Are you sure you're going to close? And I would all the time tell them that, hey, there is no law on the books that you have to be you have to have a showing, or you have to go inside to purchase a house. There isn't anything still. So I could still buy a house sight unseen, as long as you can close and kind of see the deal through. That's all it matters. And that's what I mean. Kind of going back to your question, is that yes, I mean, that's how we did it. I mean, we understood what it was, but those were in a relative progression of your career, if you want to call that, James, right? I mean, you're still young. As you're going, you're evolving and things like that. So I sensed the market was down, but the credit was horrible. I mean, you wouldn't get any financing and things like that. But we got through it, and obviously I was using private money as well at the time, so we would buy a lot and all that. So it was all about doing the right thing and kind of moving on to one project after another. And you build that momentum slowly but surely. And once you build that momentum, boy, I mean, really good things happen.
Yeah. Yeah. Real estate. I mean, I don't know how many people don't realize this. First of all, a lot of realtors doesn't know what investment houses are, right? I mean, they do not
Sure.
know much
Mhm.
about investment. They are more of a buy, sell transaction people, make money on the commission and move on to the next one,
Right, right.
right? Second is real estate do provide a lot of different opportunities for people, for a person who's willing to think differently, right? I
Sure,
mean, yeah,
sure.
yeah,
Mhm.
you find it very hard to get, banks to lend to you, and
Right. Mhm.
you went through a different way, right? The same
Right.
thing with me when I was doing my single family houses. I was doing hard money loan, and after that going to the Fannie Mae loan. At some point, I say, okay, forget about the hard money. Let's go look for private lenders who
Sure.
are normal people who are going to give me a much lower interest rate, because for them they are happy, right? They give 8%, they're done, rather than going to hard money 13, 12% with a 3-point fee and all kind of things, right?
Right, right.
So you do things differently, and that's allowed in real estate, right? So
Absolutely.
so much of creative stuff you can do, not like stocks, right? Stocks is like you see what's happening, you put the money, it disappears into the cloud, and maybe it goes up, maybe it goes down, you never know, right? And someone
Right,
is
right.
controlling, right? Whereas real estate is you are the top of the food chain.
I totally agree with you. And
Yeah.
I'll share something interesting.
Uh-huh.
That whole philosophy of doing the right thing, right? So there's this whole concept that, okay, the private lenders have to come in, they have to come inside, inspect your houses, how you're doing, do
Mm,
a thorough inspection. Are you really doing what you're supposed to be doing?
mm,
In my entire career, my hard money lender only came the first time.
mm.
And first time when he came in the living room and he saw what mayhem was going on inside, because I was ripping everything down and I was doing all kinds of crazy stuff. And my philosophy always has been is that do the right thing, whether that means for the tenant, the banks, the inspectors and whatnot. So once he came in and he saw that, oh boy, this guy is like completely off the charts, meaning he's doing like over and beyond as far as what things need to be done. And I always welcome the inspections, that's never an issue. But the whole idea is, in any interaction, for example, like whether you're talking to your lenders, your tenants and things like that, all you're trying to do is adding value to that interaction, right? So how you can help, how you can sort of, do the best you can. And that has always been my mindset, is that, but going back to, what I was saying, is that once he saw, he's like, oh boy, Sakar, I'm not going to waste my time coming to your houses and things like that. And that relationship, James, continued for probably a good, 15 some years. And
Hmm.
now we don't use them as much, but that's the kind of level you get to. Is, I mean, same thing with lenders. Like once lenders find out that, oh boy, this guy does really a great job. I mean, I can go on stories and stories like this, but once someone knows that, okay, what type of work you do, what level you play at, and things like that, whether that's inspectors, appraisers. I mean, we deal with a lot, as I shared, we deal with a lot of voucher-based clients, which is Section 8 or lots of other housing programs. In Baltimore, we have a saying that, okay, if it's Mr. Sakar or Miss Anu's, which is my wife's house, it has a certain brand to it. Is that it has a certain like a style, a level of finishes and things like that, and that has done wonders. That, I mean, people will call you saying, hey, someone, like a lot of these housing programs will try to, do like a displacement, like someone's house catches fire, or, has some, life event that they need to be, placed within 24 to 48 hours. We get those calls, believe me or not. And it's a very humbling feeling that you are able to be in that position where, people can say that, okay, we relate to you in a certain way as far as, what your quality is. And it's a nice position to be in. And as I say, like, for someone who came to this country with almost no money, and fast forward, let's say 20 some years now, and you are into this stage, I mean, I feel very blessed and grateful that you come to this stage. And as I shared, it's a lot of hard work to get here.
So what do you, before I forget my question, so I mean, you bought a lot of land in India,
Sure.
and I think it appreciated and all that, right? Compare
Mm.
that experience to buying deals in the US. Which one's easier?
Um, so there are a couple of things, James. Is like, one is the pace of development, and the systems, the rules, and things like that, right?
Hmm.
So you could buy something, let's say overseas, right, and not have, good rules and laws, and kind of, to basically, like, let's say if I have lots and things like that, right? So
Hmm.
you would sell that, and that's when you would get it, right? But in US, right, you, whether it's multifamily, single family, and things like that, right, you can have the cash flow numbers work for you. There are not that many countries where you would find that these cash flow numbers work. I mean, in fact, back where I am in India, like, these cash flow numbers that work here, they don't work there. So those are the major differences. Then obviously you have the support of, let's say, the rent code, and things like that, where if someone is not paying rent, you can legally go through a rent court and an eviction process and get someone out. But in the other countries, for example, there's no concept of rent code. You would probably have a illegal squatter staying in, and boy, 6 months, 8 months go by, and they're still not getting out. So there is a lot of, like, these things that, one is the rule of the law, right, that helps you, the system. And plus, this whole cash flow metrics is a whole dynamic by itself, that in fact, you have to be very savvy about which cities or which areas you're investing and things like that. And they don't work. I mean, even in US, as we all know, these cash flow numbers don't work everywhere. You have to pick the right neighborhoods and the safe neighborhoods, and make sure those cash flow numbers work for you. So those are some of the things I would say at the top of my head. I don't know if I answered your question there, but
Well,
I was.
yeah, you did. So let's go deeper into how did you go from 3 or 4 houses, and then later you got to 13 to 14 houses, right? So
Sure.
did you go through conventional, I mean, like say credit union, did you put 20% down and buy these houses in lump
Sure.
sum?
So I'll give you a quick version. Like, as many of our viewers and listeners would know, the
Hmm.
BRRRR strategy, as we call it, it was,
Hmm.
for lack of a better word, pretty much that, right? It wasn't called like that then, right? But I would, first few houses when I bought them, I bought cash with my own money, things like that. Maybe took a little bit of money from hard money lender for, let's say, financing the rehab and things like that. So one thing I think listeners and viewers should note is that I was working. I mean, I was making well over 100 grand a year. My wife was also working, so we both were high-paid IT professionals at the time, right? So we were still making good money. But if you're buying so many houses, right, you eventually run out of your money. So all of my portfolio definitely has been a blessing of good relationship with hard money lenders and doing the right thing. But then what actually also greatly helped was that I have been buying and holding, right? So I have always been like, I still have, very few houses I have sold, to be honest with you, things or, the only houses, like, let's say if I sold was, okay, I have only one or two houses in a certain zip code and, it doesn't make sense. So we kind of sold some of them. So those were very targeted sell that happened, right? So most of these houses, then, we went on and on, right? And as you can see, if I bought these houses at, let's say, 2000, 2001, things like that, right? So you can quickly figure that my LTV basis was low, my cash flow was, a lot higher and things like that, right? So as 2008, 9, 10 came along, we had good cash flow as well. So it was all a sort of a combination of our own money, some private money, also helped by a good cash flow that we had. And then, we got some line of credit over the years. We got, line of credit through the banks, things like that. We would go to credit unions, refinance our properties and things like that. What I never did is that kind of a cyclical refinance to kind of keep pooling or equity harvesting, as we call it, right? So I never did that. We can argue, there are good or bad, like equity doesn't pay the bills. I get that, right? So, sitting equity doesn't help, right? So I never did that, but I always, was having good cash flow. And I always kind of kept that sort of, I was debt averse as well, right? So I wouldn't take, much debt more than what I needed. If let's say if I'm pooling 8 or 10 properties and refinancing through, let's say, a credit union or a local bank, right? So I wouldn't take more than what's needed. So all of this was a combination of things, like some private money, some our own proceeds, of course, helped greatly by, the cash flow that we had and things like that. So as I think viewers will relate, as you start out, you need a lot more capital, but as you, I think, mature, your need for capital tends to reduce. You can, like, pretty much self-fund the renovations or some big acquisitions you can do by yourself. So that is what I think I would say has been kind of my story back then.
Got it. So the burst strategy is when you take the hard money loan and then later you refinance into a longer term loan, I guess, right? That's
Correct.
Yeah.
So
I call it double closings, right? So double close, I mean, basically a burst strategy, right? Buy,
yeah,
rehab.
you can say that. Like, obviously, I mean, the technical term is like, okay, you buy, renovate, rent, refinance, and go on and repeat, right? So that's kind of the acronym for it. But the idea is that you are using it, and then, as far as the capital stack goes in between, it can be a combination of things that, you could do it. And, the big part is the refinance, so that you can take your money out and then go repool that money into future projects, right?
Correct.
And like, let's say if I have so many properties now, one can kind of get into a situation where you're going back to your older properties and refinancing them continuously. I mean, you can argue good or bad, but my take on it is that the more you refinance, the more debt you have the whole time, and it kind of then defeats the purpose. Like right now, I mean, I probably have maybe 30% debt that what I had. So let's say if I took a loan out on, let's say, 7 or 8 properties, now that loan size is so less that literally I could sell maybe 2 properties. Like loans that were like, let's say, into 700, 800 grand have shrunk into like some 250, 300. So, you can imagine the amount of equity and the amount of net worth that all of this does. So it's a long-term game. It sure is not a sort of a quick strategy or a quick fix. Like typically, like a sort of a market play that we do within multifamily. It's a little different.
Yeah. So this 200 houses across how many years?
You can say a good 15, 16 years, because
15,
we
16
were,
years. Got it.
yeah, so we were buying actively still like 16, 17, and like around 2018 timeframe, we bought portfolio, we bought bunch of multifamily ourselves as well.
Got it.
So till I think 15, 16, we were very much active buyers and repositioning and things like that.
Got it. Got it. Yeah, I did a lot of equity harvesting, is what you're saying. I bought,
Mhm.
I think 2013, I bought like 2013, 2015, bought like 13 houses. I did refi twice, not only once. Keep on refining my own houses, right? When
Right, right.
every time we take out
And
money, we go to
sometimes
buy.
you have to do it. I mean,
Yeah.
it's not a sort of a golden rule in stone, right? I
Correct.
mean,
Correct. Yeah.
everybody has their own objectives and different sort of situations that present themselves, right? I
Yeah.
mean,
Yeah.
you as well can. I mean, the great thing about, I guess, the positive, I should say, is that now I can sell properties at a at a deep discount or like really lesser than a
Correct.
market,
Mhm.
and move on. Like I don't have much stuff tied in it. I mean, that's kind of the ultimate goal, that you have free and clear properties. And again, it's a relative goal, right? I mean, even if you can say that, okay, my portfolio is 60% free and clear, I mean, that's still well achieved
Oh
goal.
yeah, absolutely. I mean, it gives you just a lot more peace of mind, and it's all yours, right?
It
So
it absolutely,
yeah.
and I mean, just to share a little advanced strategy in all of this is that real estate, as you I think alluded to earlier, James, is that it gives you so many tools, right? I mean, just to kind of give you some examples here, is that you can take these properties and offer as a collateral to a lot of different things that you would want to do, right?
Mhm.
So I have as sort of years went by, I would have a franchise business, and I would say that, hey, here you go, there are like a couple of these properties as collateral, like where we I mean, this is my home office where I'm sitting. It's about a $2 million house. I built it myself. But again, at the time also, I had a good relationship with the bank had a always a good, sort of record with me. I mean, I knew the chief credit officer, things like that. And they knew me very well. So they said, yes, we will do the construction loan and all that. So I built this whole single family house where I live myself. And
Mm.
it's a completely a custom house. But again, these are the things that kind of come at a later stage. But when you have lots of equity and lots of sort of your record behind your back, all these good things happen to you, and these are natural. I mean, I'm not like chest thumping or anything. These are just the natural progression of what can happen to you, basically.
Correct. Correct. Absolutely. Absolutely. I mean, once you work hard and build up that equity, you can do a lot of things, right? I mean, my,
Sure, sure.
my houses right now, I mean, we have two more to go, and actually it's on the market right now, so we're selling it off because we have moved all to multifamily, right?
Sure.
But you're right. You can start from beginning, build up that equity, and you can do a lot of things with that, right?
Absolutely,
So let's
absolutely.
talk about how did you manage these 200 units? Because even when I was managing 13 houses, it was like so painful for me. I was trying to get out from this.
I know.
So how did you grow your organization? How did you, create that
Sh-
asset management and, your company, and how are you guys managing these 200 houses?
Right. And I tell you, James, the key comes down to is having uh, doing a good job in renovation, right? A
Mhm.
lot of times, and I have seen this observation for, I mean, decades now, and I've learned myself through networking with a lot of experienced folks who have done landlording of like 300, 400 houses all
Mhm.
by themselves over the years. So I'm not any smarter or anybody than those. But what I consistently found, James, is that growing too fast, too quickly, and then doing a horrible job in your renovations, those are the big problems, that you are growing, but at the same time, your quality is not good. And that is miserable, because people will keep on calling your property management company. Property management company will pretty much not want to do your houses then and things like that. So
Mhm.
coming back to my story is that I realized that. And as I shared earlier, right, we would do the same renovation again after 2, 3 years, right? And then
Mhm.
we fix that mistake saying, hey, let's do the right thing the first time when it needs to be done. And then we avoided probably 80, 90% of the problems. And where I think people tend to kind of miss upon also is that doing a voucher-based housing is a tremendous achievement to any portfolio that they can do. And what I mean by that is that when the inspections happen, the inspectors are looking for every single detail, the gaps, the outlets, the plumbing, the fixtures, you name it, whether your windows go up and things like that, whether your roof is in good shape and stuff like that. So it's a very thorough inspection. It's a hard inspection, as people will know. So it's a very detailed inspection. And what that does is that it keeps your quality up as well. So you have the initial inspection, you have the sort of the annual inspection as well. So your properties are great, your tenants are paying you, things like that, right? So, and how we sort of manage now is that back then in 2008, while I was working, there was a brief detour we took where we gave a handful of our properties to a property management company. But after an experience of year and a half, we discovered that, you know what, the type of service we are getting is not great. We know that we can do these things ourselves in a cheaper, cost effective way, and at the same time we can rent also properties in a much better way. So we took that management in house and we never looked back. And as I shared earlier, that my wife is a big part as well, like, just like your wife, James, manages the property management side of the house as well.
We
So
do the easier ones.
right,
We do the
so
easier job, right?
that's a that's a that's putting it mildly, right?
Yeah.
But where we grew is that, on the front end we would do a good job, then helped by inspections and things like that, so our properties would stay up.
Mhm.
And it's a team. So right now, I mean, we have about four guys on maintenance. We have in office,
Mm.
we have about 3 or 4 people who are looking at, let's say, the books, the courts, the mails and things like that. So it's certainly a team effort.
Mm.
But I think where one has to understand is that what are sort of your main pillars of success. There would be, doing a good job upfront in renovations, and then having a good crew to work with. And where I think things get also easier for us is that we are very easy to deal with. If someone is calling us, we'll say, hey, fine, let me see who can come out for any maintenance, things like that, and we'll send them right away. So there's no no delay or no dissatisfaction of sorts. And
Mm.
sometimes if we make a mistake, we are humble enough to say that, hey, we apologize. I think there was a mistake or things were not done right. So it's just being, very honest, very upfront about it. And I share your sentiment as well, James, where there are days where I think you feel like, oh my God, there are just so many service tickets just suddenly came along. And then, you have to sort of discount that also by saying that, hey, you know what, there was a big storm, or there was a huge downpour, and that's why we just suddenly see a flurry of tickets that happen. So
Mm.
it's all a perspective. Sometimes is that, okay, if you're saying, okay, we have 200 properties, you're not going to have a quiet day. You're gonna see like 2 or 3 tickets sometimes a
Mhm.
day.
Mhm.
But where I think you have to compare contrast against is that ratio, is that, geez, you have so many houses, so you're gonna have some activity. The question is that the right problem? Or I always keep on asking myself, is that what could have been done better to avoid this? And that has kept me in good state all the time, is that doing a good job up front, and then having a good team as well around you to take care of all these things. I don't know if that helps, but
Yeah, yeah, absolutely.
a bit of a long answer, but I wanted to express it fully.
Yeah, I know. It's important because you are just. I mean, the reason why you give a long answer because you're so passionate about it, and
Sure.
you want someone to really take the value out of your answer, right? So
Absolutely.
I-
And it's not a quick fix. I don't want to like people to really think that, oh yes, in suddenly 5 years, you can build up a portfolio. I mean, it doesn't happen unless you have sort of a silver spoon, or you're really from a Blackstone hedge fund group and things like that. That can happen, but building a organic portfolio like what I have done, it really takes time. I mean, you'll find a lot of people having, 5, 10, 15, 20 some houses, but as you scale up, I think the type of work you do, the type of things you look at, it does change. So I'm kind of a big believer in a lot of those philosophies about, as we call it rightly, what got you there won't get you to the next level, and things like that. Like famous Marshall Goldsmith will say that, all of those philosophies help. And I love this whole real estate game where, I mean, you're studying the accounting, you're knowing, all the different things that come with it. And it's very fascinating that how much you can learn and kind of get to that next level. It's not same as, like a W-2 job where you may be looking at just the IT side, but then you don't know how taxes would affect you, or how, assets you need to build up and things like that. I mean, for listeners and viewers, if you're listening, I would say that go find out what a personal financial statement is. And if you haven't put one, give a deep thought into it. That will kind of set you on a good path, understanding what the assets, liabilities are, and understand where you stand. Because personally, that was a big eye opener for me, that I didn't know what all these things were before back then. But as I grew, I was like, whoa, this is extremely important and extremely powerful, just from a personal finance perspective, basically.
Yeah, I mean, when I was doing my MBA, I mean, you're a tech guy, I'm a tech guy. Sometimes we think all tech guys are super smart guys. We are the smartest guys out there. We know math very well. But later, when I did my MBA, I realized, oh my God, the financial guys makes a lot more money than all of us. what's the
Absolutely.
What's the point of
Absolutely.
being good at math, right? So
Absolutely.
you have to be good at the financial literacy, right? So,
I agree with you, James. And the interesting thing, but I think you're alluding to it, but I'll maybe clarify, is that sometimes we know things, but the application of it is more important.
Mhm.
Like, for example, you would know technology, but how a technology can solve a problem is more
Mhm.
important. And that's where we kind of get in the trap of that.
Mhm.
I think knowing information and knowledge is great, but how you can apply that knowledge and information to kind of have some productive results for you, that's
Got it.
where sometimes I focus, is that sort of that applied, or the application of things, is where I think I like to steer, and how that can benefit someone, is where I
Got it.
like to
Got it.
get.
So now some of the audience I can see really, they are thinking, you are a lucky guy. You started 2002. You picked
Mhm,
up a lot of assets in 2008. So right, say right now, you did not do any of this real estate right now, right? You're in 2020, you're on COVID.
mhm.
Do you think you can repeat the same thing that you did if you go another next 15 years?
I think you can. I think you can, right? I mean, the question becomes is that, and of course, it will vary. I mean, your run rate will vary, what market will do, and things like that, right? So, prices, what they were, perhaps are not now. But it's really and to continue that thought, James, is that there are definitely people right today who are building the portfolio. It's all about how big dreams you have. It's not about oh, can I repeat the same portfolio exactly like that? It's not going to be like that. It's going to be something different. The question is, do you want to be that big? And it's always that next level challenge. So I would say you can do it. I mean, things will vary. The question is that, do you want to do it again? And for me, I think I have had enough, and that's why I moved to multifamily. And the reason I moved to multifamily as well is that, I mean, how many houses you're going to do, right? I mean, I did a couple of hundred, some now, right? So I saw the benefits, of course, of multifamily as well. My capital was large at the time. So I went in, bought, I think it was like early 2018 or so. I went in and bought like 15 apartments by myself. Then after a few months, turned around and bought another 66 units. This is all by myself, not syndicating or anything,
Mhm,
you know
mhm.
but then you see the benefits of it, like, okay, you can do the value add, you can do the NOI increase and things like that, as we normally call it, right? And then, it will do good to you as well. So I saw both sides of the coin, right? The question is, depends on your goals, right? For a lot of investors listening, or probably I should say 95% of the folks do play in the single family space, and they are devoted to it. They want to grow like whatever, 10, 20, 30, 40 houses. And it's great. You don't have to, I think, emulate someone's portfolio of sorts, right? I mean, you have your own race. You can do it again. The question is that, yes, you're going to be dictated by where you are investing, what the market is doing to you and things like that. I think the important fact is that whatever goals you have, as long as you can achieve them and be happy with it, I think that's to me, that's more important than just trying to run for a number. To me, sometimes that can always be fleeting, like you can be at like whatever number. I mean, for example, just to give you an idea, when I was at, I think, 100 some houses at the time, that was back in, I think, 2014 or so, my CPA told me that, Sakar, you can now retire. I mean, you have enough cash flow to live off of yours. I think that was like 13 or 14 at the time. And that was a rude awakening to me, because I didn't know, because I was so much in the weeds of like sort of growing and next level and this and that. And to come from a CPA, I was like, okay, Jeff, I think I understand what you're saying and I trust you, but I said, you know what, I'll give a deep thought to it. And sure enough, after a couple of years, we slowed down, kept on buying the larger apartments and things like that. So the goals change. And I would say, I mean, it's all about what you're trying to do, and, just take the successes and failures that come with it. I mean, you're going to have so many dips. I mean, I have had more dips than I really care. But it all mattered that, I was on the road, I was on my own journey. So it's all about that sort of satisfaction. And it's a lonely road for sure,
Got it. So, I mean, we can say that, you have good number of houses, very low leverage, you're doing very well in your life right now.
Sure.
Why do you keep on doing what you are doing?
Let's look at it this way, right? I am what, I guess 43, 44 now and retired. So you have to do something. And what I really love about is that I love what I do, right? So I am constantly like, upgrading our apartments, for example, and things like that. So I just keep on to the next level. So I'm like, for example, I'm just in the midst of some sponsorship discussions into multifamily and things like that. So where I love, James, is that I'm a busy guy. I love to stay busy and I love to do what I want to do. I mean, people will think crazy, but I am into swimming franchise right now. I am doing podcasting myself. As you know, you've been a great guest of mine earlier as well, right? And I have some multifamily interest. I raise cap. So I love that hustle, so it's always, life is about action and activity. You don't want to be, people, as you would relate, James, that the retired is a concept where when suddenly we say that someone is retired, meaning, he's on a lounge chair watching TV and news and all that, that's the picture we get. It's not about, yes, I'm basically financially free, I can do what I want to do, but I'm really passionate about doing stuff. I love the hustle on the road, and I love to, still answer calls and see how can I add value and things like that. I mean, my admins love our office saying, Mr. Sakar, how quiet it is. And I tell them that, I say, it's harmony. You got to understand that you do things in life and you're helping them, you're doing things right, and that brings harmony all around you. I never had fights with my contractors. I have had probably a few fights with my tenants. And I mean, that just comes with the territory. But it's all about having that harmony. And once you have that peace, that's your mental peace. And then you're going back to your sort of whatever you want to do. And that's how it is. I mean, for all I care, yes, I could sit quiet and just be myself. But I guess the God has built me in such a way that I want to carry on and I want to do bigger, better things. And that's where I'm at.
Yeah, exactly. So, Sakai, it has been really a pleasure having you here. Can you tell our audience how to get hold of you or your company?
Sure. So people can find me at Facebook, Instagram, LinkedIn. I'm all active there. Premiumcashflow.com is our company. Premiumcashflow.com also has a podcast. I regularly hold podcast about almost 5 times a week now. We have that podcast with various guests. You can reach me at like info at premiumcashflow.com. There, you'll find lots of news articles, reports, things like that. So I'm very much accessible in all sorts of media, for example.
Got it. Awesome. Thank you for coming and adding tons of value for our audience and listeners.
Thank you. I appreciate it, James. You're doing a great job. So continue. I appreciate you as well.
Thank you. Thank you.